Hey everybody, good to be here today. It is Wednesday. It is time for managing an options portfolio. And so whether you're watching live or on a recording, we're just happy you're here. I'm joined alongside in the chat by a good friend of mine, Cameron May. So he's not only a friend, he's a good colleague, and I've learned a lot from Cameron over the years. So make sure you follow him on X. He posts extra content throughout the week. I post extra content throughout the week on X as well, at Cameron May CS, at Brent Moores CS. Now let's hit up the disclosures. Then I want to talk to you today about selecting an option strategy kind of based on what the Greeks look like and what your expectations are for the trade. So we're going to do that, and then we're going to go through managing existing options positions, because we do that each week, of course. But before we get to any of that, let me just mention options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It is not a recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money software application is for educational purposes only. I may not factor in commissions or fees in these example trades that I do, but just realize they are a real thing that you need to factor and consider. All investing involves risk, including loss of principal as a possibility. And rolling strategies can entail additional transaction costs. Past performance of any security strategy does not guarantee future results or success. And there we go. I think that's what I need to tell you on this. Let's take a look at the markets, because we've had a little bit of a pullback in the market right now. Here's the SPX, and I want to just kind of look at this as context for what we're talking about, because we've been in a pretty strong trend here. From the end of March, early April, it has been doing this, and we've had little pullbacks along the way. So what I don't want to do for our purposes is overreact to what we've seen. We're down about 0.6% today. We were down yesterday. The NASDAQ is going down even more. Kind of some of those bigger tech stocks are going down a little bit more. And just because we've had that big of a pullback doesn't mean that the whole market's going to fall apart. I don't know exactly what the market's going to do, but often the way I kind of look at it is this. I look at the pullback that we've had and I compare it to past ones. And I say, is it kind of out of character with what we've seen in the past? And as of yet, I'd have to say, probably not. I mean, this pullback is kind of just routine in terms of the pullbacks we've seen. But of course, you need to judge for yourself. And at some point, the market isn't going to trend up exactly like this forever. And so you may want to make some adjustments to your portfolio, and trades that you add to your portfolio, you may want to, consider what kinds of trades that you want to add to your portfolio. And when we talk about considering what kinds of trades you want to add to your portfolio, let me kind of mention this, because I think it's an important thing. Your option Greeks can kind of help guide you, okay? And I'm going to focus on 3 option Greeks here. One is going to be Delta, and Delta tells you for any position, or if you're looking at a portfolio, how much gain or loss we would expect given a $1 move in the underlying, okay? So if I have a position on Ford Motor Company, say it's a long put and the delta is minus 0.7, that would mean a $1 gain in Ford stock would lead to about a 70-cent loss, 70-cent loss, because I mentioned a put, in Ford stock, okay? So Delta gives you the basic direction of the stock, whether it's positive or negative. Positive delta trades are bullish. Negative delta trades are bearish. The higher the delta, the more bullish or bearish. The higher the value, the more bullish or bearish it is. And delta is around zero-ish You're probably not going to get exactly zero, maybe more of a neutral type trade. All right. So here we go. So this is, our first thing is when you're considering this trade, bull or bear. Okay. Now, somebody in the chat mentioned gamma. Now, I'm not going to use that as one of my main ones, but let me address what gamma is. Gamma tells you how quickly delta can change. Okay, how quickly delta can change. So if you have a higher gamma, that means if the stock moves up or down a little bit, your delta is going to move more rapidly, change from high delta to low delta or low delta to high delta very rapidly. When does that occur? Typically, that's going to occur as you get close to expiration. Sometimes we'll talk about something called gamma risk. Okay, gamma risk. And when we talk about gamma risk, usually the context is this. If you hold option contracts near, that's supposed to be risk right there, near expiration, then the delta can change more quickly on you, and that can present more uncertainty in the outcomes that we're talking about. Okay. But when we're looking at a general trade and we're looking out at, say, a month to do the trade, gamma isn't going to be the one of the main things I'm going to look at here on this. But it is, it is one of those option Greeks there. And just remember, gammas increase as you get closer to expiration typically. And that means more risk is going to be in your trade as you get closer to expiration. But when you're trying to just come up with your initial trade, delta is probably the prime, maybe the prime consideration there. Are we going to be bullish or bearish on that particular trade? That may start with whether you're bullish or bearish on the market. Or maybe you're bullish on the market overall, but you want to take a little bit of the pressure out of the market, pressure out of your portfolio of, maybe you're a little bit overly bullish and you just want to make it a little less bullish. Well, delta may be a consideration there. We'll look at examples on this in just a minute. And then there's theta. Theta is time decay. Now, you may be going, well, I want time decay to benefit us. Okay. I want time decay. I want theta positive. I want time decay to help us out on the trade. And yes, however, you can't always have it help you out depending on the type of trade you want. Trades that have positive time decay tend to move much more slowly and have less potential benefit there. So really, when we talk about time decay, we can say, do we want positive time decay, positive theta helping us out, or often it comes down to, or do I want a bigger potential move? Okay, bigger move. And here's what I mean by this. Let me give you an example. I could do a short put, okay, and end up with fine time decay. But the reality is, if the stock goes up a whole bunch, which is what I want on that short put, I'm pretty limited on what I can make. I could do a long call if I'm bullish instead of that short put. And you know what? Time decay is going to work against me in that scenario. But I could make there's a potential for much bigger gains on that trade. So sometimes it's a choice of whether you're going to have positive time decay or you want to make a trade that's going to take advantage of a bigger move. Okay? Let's do one more. Let's say the other one is Vega. Okay? So what's Vega? Vega is how much the underlying position is going to move in comparison to changes in time in terms of implied volatility. And for this, we could look at either the VIX, okay? And we could say, is the VIX, that wasn't a very nice VIX there, is VIX going up or is it going to head down? Not so much where is it right now, but is it going to go up after we enter the trade, continue to go up, or is it going to continue to go down? And so that's where that's our decision on either the VIX or the stock's individual implied volatility. For those of you who are not aware, the VIX is a measure of the implied volatility on the S&P 500 as a whole, but obviously not all stocks are equal within the S&P 500. Some have higher implied volatility, some have lower. Is it going to rise or fall? Okay, so that's what my little up arrow and down arrow mean. Is it going to rise or fall on that? So those are kind of the considerations. So here's what I want to do. I do want to look at example trade, an example trade on this, and then we'll look at our other trades as well. But I want to kind of just go through real quickly, and it's going to be fairly quickly, whether we're looking at kind of this template in terms of what we're considering here. So if we just take long stock, so again, these are all going to be options except this first one. Is long stock positive? Hold on, I did something wrong there. That did not work out right. Is long stock positive delta or negative delta? And let me just see if I can do my control key on that. It's positive delta. You buy stock, it's positive delta. 100 shares of stock has 100 delta. So that's going to be a very directionally positive thing. Now, if you were to short stock, which we're not going to get into today, other than to say, just keep in mind shorting stock has unlimited risk, then it would have a very negative delta effect. But in terms of theta and vega, in terms of time decay and implied volatility effects, it's going to have none. It doesn't have those option Greeks, theta and vega. It's not going to affect it. There's no time decay on stocks. Okay. What about long calls? Well, long calls, I'm going to put kind of this double plus sign. What do I mean by the double plus sign? What I mean by the double plus sign is it can be substantial. Okay. So it can be a substantially positive delta there if I do just a long call. Okay? That's a substantially positive delta there on that. What about theta on that? Well, we already mentioned that. This is one of those things where time decay can work against us on that. And so time decay is going to be, okay? And looks like I may have lost my stream. Are you guys still there? Yep, we're back. Okay, so sorry about the little thing there. Okay, so hey, let's go long puts. What are long puts? Long puts have the potential for significant delta, but on the negative direction. It's a bearish trade. If I'm looking for a bearish trade, I may do a long put. But like long calls, my theta is going to be negative and my vega is going to be positive on those. All right, short puts. What have we got short puts? Well, short puts are positive, okay? Positive delta. We're bullish on short puts, just as we're bearish on short calls. Now, often we don't talk about short calls in this class because if you just do a lone short call, it's a theoretically unlimited risk on that. But as a part of another trade, sometimes we'll look at the different components, long calls, long puts, short calls, and which you can kind of add these together to try and figure out what's going on. But if I'm in short the contract, then my theta is going to be positive on those. My theta is going to be positive on those. And so that's one thing that's attractive of short puts, short calls, is theta is positive. My vega, negative on those. So I'm probably more likely to do those if I think implied volatilities are going to go down. All right. What about verticals? What happens when we do verticals? Well, when we do a vertical, a short call vertical is a bearish trade. Okay. Short call vertical is a bearish trade. What about my Greeks? Well, if we do them out of the money, we're probably we're gonna have a positive theta on that if it's out of the money. However, anytime you're talking about a vertical, any of these verticals, the long position and the short position are going to largely offset each other. Therefore, the thetas and the vegas are going to be much reduced generally on these vertical spreads versus if you just do a single option. Okay, so short call verticals are going to have a negative vega. Short put verticals are bullish trades, but both the and are going to have a positive theta and a negative vega. Those are going to be reduced, however, because it is a vertical. Long call verticals are bullish trades, so it's a positive delta. Long put verticals are bearish trades, so it's a negative trade. And my theta on these kind of depends on where the stock is in relation to the strike price. Okay. In general, what I'm going to say is our theta is more likely to probably start out small, but negative. But it just depends on the strike prices that you choose. So when you're doing this, it's probably not as big as a factor for you on that. Vegas, again, it's going to depend on the strike prices that you choose. But there we go. Now, I'm not going to have an exhaustive list of every possible strategy you have, because I would just take the whole time. But I'm trying to hit up the main strategies that we talk about. Iron condors, kind of neutral, to be honest. Iron condors are kind of neutral trades. It depends where the strike prices are you choose compared to the current stock price. Same thing with butterflies. It depends where the strike prices are in relationship to the current stock price, but we're going to call that neutral. Calendar spreads, same deal, neutral compared to the current, where the stock is compared to the strike prices that we choose. All of these are positive theta trades. Time decay helps us out on all these. But remember, to my prior point, when we're talking about these, if I want a big move on long calls, long puts, I'm more likely to get I have more potential upside on those long calls and long puts than I do on these. And part of the price of that is theta. I'm getting the positive time decay on that. Okay. Now, vega, iron condors, negative vega. Butterflies, negative vega. Calendars, positive vega. And diagonals, these can be positive. I'm not going to call them neutral, because if you do because you can make them more positive or more negative. Is it going to let me do that on that field? It's not going to let me do that. Let me just try this. Oh, actually, stop it. I should have clicked yes, and then it would let me do that. Okay. It's not going to do that. Okay. Well, anyway, positive or negative, I think I need to do this. And then we'll try this one more time. See if that works. There we go. Positive or negative theta. Generally, positive theta, I meant positive or negative delta. And vega, same as calendar, generally positive. These really depend on what strikes you choose, though, on those. Okay, so there's your chart. That's your table we're going to go off of here. But remember, the three questions that we're going to be looking at are this: direction, or delta. Delta is for direction. What direction do I want to add to my portfolio? Theta, do I want to emphasize my time decay or the potential move, or kind of have a balance between the two by doing like one of the vertical spreads where we get that kind of balance there? And vega, do I think implied volatilities are going to go up or down here? So let's do that. I'm going to get off this page here. And I'm going to pull up my Thinkorswim. And here's what I'm going to say. In terms of direction and what kind of trade we're going to add, we can look at the overall portfolio, the overall market. We can look at the individual stock as well. And so what you may decide is you may start off with the overall market and say, well, hey, I'm bullish, for example. Therefore, I want to add another bullish trade on the market. Or, I have a very bullish portfolio. I want to take off a little bit of the risk on that portfolio. So maybe I'll add another bearish trade in that portfolio. Because when I look at this, let me just get rid of, let me get rid of my groups here. And let me look at my overall delta on this portfolio. I have a relatively bullish portfolio here. Okay, I'm looking at my odd, and so maybe I want to reduce that a little bit. And I can do that by taking off positions or adding new positions. In this case, for our purposes, I'm going to look to add a more bearish trade on here that is going to maybe reduce that delta a little bit. So that's the first thing. Second thing, theta. Well, here's what I'm going to do. I'm going to not necessarily emphasize the theta. I'm going to maybe do a vertical spread that's going to theta is probably not going to be the biggest consideration here on this. Those contracts are largely going to offset each other, so that's not going to be as big an issue. And in terms of Vega, let's start with the VIX here, okay? Here's the VIX. Here's implied volatilities. And you can see where they are. And you can see where they've been. This would probably be to get back up in the 40-50 range would probably indicate a very big drop in the market. But you can see where we are. We're at about 16 right now. And if I were to draw, my line's not going to be exactly straight. But you can see compared to where we've been in a little bit, we're probably on the lower end of things maybe. And so I could certainly see, the VIX goes up, it goes down. It goes up, it goes down. Would not surprise me for this to go up here a little bit. So I'm going to target something maybe with a little bit more of a positive Vega, but there you go. Okay, now let me address a question in the chat, and then let's look at a trade here. Okay, so the question in the chat from Chuck, and it's a great question, is I said maybe I want to lower my delta. Well, what delta is too high? It totally depends on the person, okay? The SPX right now, let's consider the SPX right now, and I'm going to go through this relatively quickly, is around, we'll say 6,400, just to make the math easy on this. That means a 1%, well, let's say a 10% move in the SPX, which would be a substantial move, but certainly it happens, would be 64-point move on that. How would that affect my portfolio? Well, if my beta weighted delta is around 40 and I multiply that by the 64-point move, that 40 times 64, that's giving me about a $2,500 hit. Sorry, not 64, 640. I said 64, I meant 640 would be a 10% move, times 40 is going to be about a $25,000 hit to my portfolio. So yes, RG said 64 points is 1%, yes. So 10% move, that's a $25,000 hit to my portfolio. Now, little caveat, little disclaimer, delta isn't going to stay exactly here if the market moves down 10%, okay? So this is just a rough approximation. But for your portfolio, you need to decide how much risk is too much risk. You have to take risk in a sense if you're going to be in the market and participate in the market. There's going to be some risk there. But you need to decide, is that a lot? Because this portfolio here, this sample portfolio I have right here, for some traders listening to me right now, this would be a very small portfolio. For some, this would be a very large portfolio. So you got to kind of think of it from that standpoint. Now, if you're interested in a more in-depth discussion on portfolio risk, I have done sessions, and I know Cam has done sessions as well, on portfolio risk on beta weighting, you can just go to that Trader Talks channel and look up a session on beta weighting your portfolio, and it will go in a lot more detail than what I just went through that rough calculation there. But it was such a good question, I wanted to address that real quickly here. Okay, now, before I lose too much time here, let's look at a trade here. So the trade I'm going to do here is I'm going to look at IBM. I want to do something bearish. Remember, we looked at Delta, Theta, Vega. I'm going to look at something bearish. I'm going to look at a spread trade because I'm going to kind of minimize my Theta and my Vega here on this. And here's my premise on this. And you may agree or disagree, but my assumption is my trend is down. This is red line's a 20-day moving average. We're kind of going down and then it kind of flags. Goes down, kind of flags. Goes down, kind of flags. My assumption is this is going to continue down. So therefore, what I'm going to do is I'm going to do a long put vertical spread. A long put vertical spread. Let's just kind of look at that on our sheet. Long put vertical, delta negative, theta negative but marginally negative, Vega positive but marginally positive. And so we'll just have to see. You can also, by the way, go over here and actually look at the trade, and we'll look at what the Greeks are specifically in just a minute. Okay. So let's go here. I'm going to go to IBM. I'm just going to go. I'm not expecting this to be a really long-term move. I mean, the move down, the last few moves down have just taken maybe a week. So I'm not going to go out that long on this. I'm going to go out 23 days. And I'm going to buy a 245. I'm going to look to sell a 235. Hold down my control key. I'm going to, let me just make sure I've, come on. 245, 235. I'm going to right click on this and I'm going to analyze the trade. Okay. And this is what my trade looks like. Okay. First of all, it's a bearish trade. Here's where the stock currently is. So if the stock stays exactly where it's at, probably unlikely, we're at a slightly negative position here. Okay. If it goes down, where it becomes profitable. Okay. And you can see this represents our max gain there. If the stock goes up, which we're not expecting, but if it does go up, then we're looking to lose on this. Okay. So there's that. Now, what does the trade look like in terms of our Greeks? Well, it depends where the stock is. Okay. So at our current price, which is this price slice right here, our delta is substantially negative, which is what we wanted. We wanted a bearish trade in our portfolio. Our theta is a little bit negative. That's not a huge number, 0.64, negative 0.64, but theta is negative right now. Now notice this. If the stock goes down, if it cooperates with us and does what we want it to do, that theta actually turns positive on us. Okay. So right now it's minimal, that theta, but it can actually turn positive for us. And again, none of these numbers are huge here because it's a vertical spread. Same thing with Vega. Vega is positive on us right now, but actually that Vega can turn negative if the stock turns down enough. And again, none of these numbers are huge there on this. But that's the trade I'm going to look to add to my portfolio here. Let me go and get out of my drawing tool. I'm going to go back here. Oh yeah, let me go back here. And I'm going to, let's click on confirm and send. Actually, that mid price, let me just move that off a little bit so that we can more likely get a fill here. And there we go. Make sure you read, you read the red notes, read this, caution potential interest rate, dividend, and assignment risks exist. That's kind of a new message they're giving so just be aware of the risks and potential rewards in that portfolio. So I'm going to send that trade. We just sent that trade. It's thinking, it hasn't filled yet. We'll let it wait, but if we want it to fill, we can always go back later and go to our working orders and right click and adjust this order and see if we can get it filled. Okay. But we'll let that sit here. But what I want to do is I want to turn some time to other existing trades that we have in this portfolio here. So I have them just kind of alphabetical here. But there's some that definitely need some attention here. So I have a Nike. This is a diagonal spread, but some of you may recognize this more because we've done this in this class. We've looked at this in this class before. That's kind of what we're calling a poor man's covered call, so to speak. It's not a covered call, it's a diagonal spread. But we have a Leaps call, doesn't expire for 394 days. We also have a short call on this. And the short call, hey, it's doing great, but we're going to look to roll this out. There's only 2 days to go to expiration, right? We could just let it expire, okay, if we wanted to. But the goal of this trade is to have this kind of underlying bullish call option and then sell and get theta along the way. We're going to sell this contract. So when you are looking to roll or do a new contract, just remember you still have to pay commissions if you roll. You're just doing it in one order ticket. But if you're doing that, it begs the question. The question it begs is this: what contract do I roll to? Well, what you do is when you roll is forget the past trade. This trade right here is history. It worked out fine, but even if it didn't work out fine, don't worry about this. This one's done for. Consider what trade you would do right now if I wanted to continue this trade. Well, on Nike, the one I would probably look at is usually on these, we're looking out maybe 30-ish, heavy emphasis on the ish days till expiration, just to try and maximize the theta, because if you go out too far, the rate of time decay doesn't help us much. And I'm going to go out maybe 30-ish, maybe a little less on our delta, just because my goal is to try and keep it out of the money for the most part. And this can we already talked about what delta means, but delta is sometimes used as a probability measure. So what I'm going to do here is this. I'm going to just look at my option chain on this. I'm going to look at Nike, and I'm going to go out. That's IBM. Let's go to Nike. Okay, Nike. There we go. I'm going to go out roughly 30 days. Well, there's one right on the nose, 30 days. It's not typically going to be exactly 30 days, but in this case it is. And I'm going to go to my delta, and I'm going to look something roughly, I need some more strikes here, roughly in the 30-ish delta range. And we'll go 26 delta, how about, okay? So this is going to bring in 88 cents. Now, if this were a covered call, what I would do is I'd say, look, 88 cents on a $76 stock is a little bit over 1% return. 1% return, 30 days, okay? Fair enough. But remember, we don't own the stock. We own the Leaps contract. So that is basically going to, as compared to the long position, okay, which isn't a stock, it's an option, as compared to a long position, that actually is a much larger position. Can we figure out what that is? Yeah, let's just take a quick detour here. I don't want to spend too much time on this. But the long call right now is at about $2,900 for it's an expensive option, right? Well, it's a Leafs. It goes out 394 days, $2,900 dollars on this, but which is about half, a little less than half of what the stock price is. So instead of a 1%, this is probably closer to a 3% return as compared to the underlying long position here on that. Okay. So anyway, let's do it. This is the contract. It's going to be a 19th of September 81 call. 19th of December 81 call. If I want just to roll this and use the roll feature, I'm going to right click on it. Right click. It's not letting me right click. I'm having some mouse issues, folks. I'm sorry. I don't know why it's not letting me right click. Okay. Well, I'm not going to right click on this. I'm just going to close this out. Wow. Okay. Let me get out of this. Let me first of all cancel this. Let me get out of my orders here. Working orders. We're looking for Nike. I'm going to cancel this order. And now it's letting me do that. That's weird. I'm going to cancel that order. We're out of our exit order on Nike now. Well, let me do it now. No, it won't let me do it now. Okay. So what I'm going to do is I'm going to close this position. Okay. Well, normally I should be able to right click on that and close it, but it's not letting me do that. So what I'm going to do here is I'm just going to go over here. We're going to look at our existing position. We're going to identify it right here. It's right there. You can see the little tag on that. And I'm going to buy this one back. Okay. We're just going to buy that back. And there we go. Send. That's filled. Now I should just be left with my Leaps call here on this. What I'm going to do is I'm going to add in a new position. This is actually a good thing. We didn't use the roll feature, but essentially it does the same thing. I'm going to go out to my contract, 30 days out. I think we were looking at like the 26 delta on this. Okay. 25 delta, this one, and I'm going to sell this one. I'm just going to click on it. I'm going to sell it, confirm and send, and I'm going to send that. So effectively what we did is we rolled it out. We brought in a credit along the way. How much credit? Well, look, we just sold this one for about, well, let's see, for 88 cents. We got rid of the other one for, I think, about 8 cents. So that was about an $80 credit there. Okay. And so there we go. There we go. Let's move on because we're running out of time. So we rolled that contract out. Here's another one I want to look at here. I want to look at Oracle. Oracle right now, we're losing some money on Oracle. What do we have on Oracle? I've got different positions, but I want to just look at this position right here. I have two different positions. They're not grouped right now. And this is what is this? It's a long call, a short put, same expiration date, same strike. That's a synthetic. That's like a long synthetic. And this has this position right here is kind of like, in some ways, the stock in terms of the profit loss profile. Now, stocks don't expire. This expires. Stocks pay dividends. This doesn't pay a dividend. But let's look at ORCL and see if we're still bullish on this. ORCL. And here's what I would say on this. The trend has been up. Okay. We broke that 20-day. We're flirting. We're right on the edge of that 50-day. We could hold off on this one a little bit and see if we get the bounce off the 50-day. But in this case, what I'm going to say is I'm going to we're looking to like de-leverage our portfolio a little bit or make it a little less bullish. And so I'm just going to look to get out of that synthetic on this. Okay. Now, normally when I'm looking at this, I have these in groups. Okay. And I'm going to show groups, and it may make it a little more clear if you put it in a group. And this was in here, and you can see my Oracle position right here on this, but I'm going to look to get out of this position. Now it let me right click on it. Interesting. Hold on, I want to experiment with something real quick. It won't let me right click on the individual leg now, but it is letting me right click on the symbol. Okay, well, that's something for me to know. So this was not a straddle, Dan. The question was, is this a straddle? The answer is no, because a straddle would have a long call and a long put. Okay, or for a short straddle, a short call and a short put. In this case, I have a long call and a short put. And so if you want to learn more about these synthetics, you can check them out in my advanced options webcast I do on Fridays. Several weeks ago, I did a session dedicated to synthetics here. Okay, so here's what I'm going to do. I'm going to, we're just going to exit this position here. I'm going to right click, create a closing order. I'm going to sell this, and we're going to look to get out. Now, that's a mid price. If I want to increase the chances of getting out, I'm probably going to move it off the mid price to something closer to the natural price, or at least in between the two. I'm going to confirm and send, and we're going to send that, and that is there. There you go. Okay. Now, I don't have much time left, but let me just point out another trade that I'm going to look to exit here, and that is NVIDIA. NVIDIA is not there. I got to click on the right one. NVIDIA is a butterfly spread, which we were actually doing on quite well on. Overall we're down $30. Now, it's not the end of the world here on this. This is a butterfly spread. It was doing great until NVIDIA just kind of tanked the last couple of days. Okay, so there we go. I'm going to exit this trade. I don't have time right now to do that, but we're going to exit. I'm just going to get out of this whole thing. There's only 2 days to go till expiration on that, and we'll look to get out on that. Okay. So what did we talk about today? We talked about your option Greeks, Delta, Theta, Vega. We brought up this kind of chart. If you want to take a screenshot of that, if it's helpful, you can. Just realize some of these become a little bit more iffy when we're talking about vertical spreads, just depending on where the stock is in relation to the strike price. And sometimes the long and short positions kind of offset each other to a large extent, so the values aren't very, very high. But we talked about using kind of making those considerations when you're making your option trades. Then we talked about managing some existing trades there, and including one of those poor man's covered calls, so to speak, a long synthetic, and this butterfly spread. Anyway, thanks for joining me. Thank you, Cam, for helping me on the chat, of course. And everybody, appreciate your viewing. Make sure you subscribe to the Trader Talks channel. And we are going to see you all same time next week. Bye-bye, everybody.